Equity markets plummet for the second consecutive session, albeit after a nice follow-through relief rally yesterday afternoon, bringing S&Ps actually near unchanged at one point. But again, we open up the session today, big sellers, big concerns on China, not only on trade deals, but how the ripple effects could affect the global economy, which right now seemingly struggling. U.S. side, we're here, troubles in Europe, troubles outside of a trade deal with China. China's a problem, and there's just seems to be this overwhelming, gigantic central bankathon going on, trying to keep everything supported. So right now, equity's starting to find a little bit of a few cracks in the dams, we'll call it, as the selling pressures continue. And today we got as low as we have since, we got a big intraday move, biggest since January, and also we saw the VIX index with a big move. Its intraday move, its biggest of the year, from settlement to the high print. So right now, obviously, things kind of at extremes. And if you look over in treasuries, yes, treasury yields are lower, sort of a flight to quality bid. We are also seeing a call skew bid over there. So a lot of demand for treasuries as this equity market flirts with a potential even bigger sell-off. And like the aforementioned VIX, it's gotten to its highest level since yesterday, and before that since January. So it's now north of 20. Level we haven't seen, and a settlement we haven't seen since January for sure. And that to me is 2 in a row. The VIX tends to reverse very quickly. Let's not forget there is a massive short in the VIX index, which could be starting to find a little bit of an unwind here on these levels, given the fact that it's been so low for so long. And the fact is that that whole VIX short started in mid-January as the market was starting to turn. So when we saw the big declines in the equities at the beginning of the year, we saw the high volatility levels. Obviously, there's some opportunistic selling with VIX index. They've had plenty of time to get out at very low levels. So if you're starting to see them chase here, maybe greed was driving that train. But volatility is higher on these big moves that we've seen over the last 2 sessions. And let's look at the technicals. So we are still well above the 200-day moving average, despite the big move we've seen over the last 2 days, 27.76. We need to get down to 26.60 to see a 10% correction from the highs, and a 20% correction would be right around 23.70. So I think we are still well a ways from those big, what if sort of levels. Obviously, no one wants to see the equity markets plunge another 500 points before you can find out if you're right. But I think that the buyers will probably look to wait for the dust to settle to see if there is any kind of relief bounce before they can get back in. Yesterday, they may have gotten back in too soon, as evidenced by today's sell-off. So right now, equity markets sort of leading the charge. They've been the barometer of the market really for quite some time, and we've seen very little out of other asset classes, treasuries especially. Now, treasuries are below key yield levels in the 10-year. We're well below 2.5%, likely headed to 2.40. That flight to quality bid should continue if there's a fear that equities won't be able to regain these losses in a timely fashion. So right now, equity markets still looking very, very skittish as we head into the close on Tuesday. But look out, every day is a new adventure. But if that VIX index doesn't reverse, you can expect more of the same in the days ahead.